The alarm on your phone blares. It's not a fire, it's not a drill, it's the stock market, and it's crashing. You rub the sleep from your eyes, checking the news. Headlines scream about a political showdown in the White House. The world watches, stunned, as financial markets react with the ferocity of a cornered animal. February 28, 2025 will be etched in the memories of investors worldwide. A day that began with routine market chatter ended with panic selling and plummeting indices. President Trump, back in the Oval Office after a 4-year hiatus, was determined to make a strong statement. He had invited President Zelenskyy for a crucial discussion on the ongoing conflict in Ukraine, a topic that had been simmering for years. The meeting, initially intended to showcase a united front and a collaborative effort, quickly devolved into chaos as differing opinions clashed. Tensions were high from the start, with both leaders bringing their own agendas and frustrations to the table. The issue of military aid, a long-standing point of contention between the two nations, became the catalyst for the dramatic blow-up that ensued. President Trump, known for his unpredictable demeanor and blunt rhetoric, lashed out at Zelenskyy, accusing him of not doing enough to combat the crisis. Zelenskyy, no stranger to pressure and diplomatic confrontations, refused to back down, standing firm in his position. He countered Trump's accusations with a fiery defense of Ukraine's efforts, highlighting the sacrifices and struggles his country had endured. The room crackled with tension as the two leaders locked horns, their heated exchange broadcast to a stunned global audience. What started as a closed-door meeting intended for diplomatic discussion quickly became an international spectacle. The raw footage beamed across the globe in real time. Markets, already jittery from ongoing geopolitical tensions, reacted instantly and violently to the unfolding drama, with stock prices plummeting and investors scrambling. Analysts and news anchors around the world dissected every moment of the confrontation, speculating on the potential fallout and long-term implications. Public reactions were swift and varied, with protests erupting in several cities as people voiced their support or condemnation of the leaders' actions. Diplomatic channels buzzed with activity as world leaders scrambled to manage the situation and prevent further escalation. This confrontation in the Oval Office was reminiscent of historical political clashes where high stakes and strong personalities often led to dramatic outcomes. Despite the heated exchange, there was still hope for resolution, as both leaders expressed a willingness to continue dialogue and seek common ground. Rebuilding trust and finding a path forward would require significant diplomatic efforts and concessions from both sides. Future meetings were already being planned, with the hope that cooler heads would prevail and a more constructive dialogue could be established. The global impact of this confrontation was undeniable, as nations around the world watched closely, aware that the outcome could shape international relations for years to come. In the end, the hope remained that through continued efforts and mutual understanding, a peaceful and prosperous future could be achieved for all involved. The Dow Jones Industrial Average plunged over 800 points within minutes of the Oval Office confrontation. The tech-heavy Nasdaq, already reeling from recent volatility, entered correction territory. Fear was the only commodity in high demand. Across the Atlantic, European markets followed suit. The FTSE 100, DAX, and KC 40 all plummeted, mirroring the panic sweeping across Wall Street. Asian markets opening later in the day were not spared from the carnage. The ripple effect was immediate and devastating. Energy stocks took a nosedive as the price of crude oil plummeted on fears of a global economic slowdown. The safe haven assets, gold and the Swiss franc, surged as investors fled to safety. It was a stark reminder of the interconnectedness of global markets and the profound impact political events can have on the financial well-being of nations. When politics makes Wall Street sweat, it's not just a fleeting moment of anxiety. It's a signal of deeper underlying tensions that can ripple through the financial world. The relationship between politics and the stock market is a complex dance, one that requires careful observation and understanding. It's a dance where every step, every misstep, can have significant consequences. When political events threaten stability, the markets react almost instinctively. It's a reaction born out of years of observing patterns and predicting outcomes. Markets react with fear and uncertainty, a natural response to the unknown. Investors, traders, and financial analysts all scramble to make sense of the chaos. This is particularly true in today's interconnected world. Political instability in one region can send shockwaves across the globe, affecting markets in ways that were unimaginable just a few decades ago. Uncertainty is kryptonite to the stock market. Investors crave predictability, a sense of knowing what the future holds. Without it, the market becomes a volatile and unpredictable beast. A sense of knowing what the future holds is what keeps investors grounded. It allows them to make informed decisions, to plan and strategize. When that predictability is shattered by geopolitical tensions, the market sentiment can shift with terrifying speed. It's like a storm brewing on the horizon, unseen but felt by all. Market sentiment can shift with terrifying speed, leaving investors scrambling to adjust their positions. It's a race against time, a battle to stay ahead of the curve. The Oval Office confrontation was a stark reminder that political risks are not abstract concepts confined to textbooks. They are real, tangible forces that can disrupt markets and decimate portfolios. These forces can disrupt markets and decimate portfolios, leaving investors to pick up the pieces. It's a harsh reality, but one that must be faced head-on. The images of the heated exchange, replayed endlessly on news channels, served as a wake-up call for investors who had become complacent. It was a reminder that the world of investing is fraught with risks. Replayed endlessly on news channels, these images served as a wake-up call for investors who had become complacent. It was a stark reminder of the ever-present risks in the world of investing. This event underscored the importance of understanding the interplay between geopolitics and investing. It's a relationship that cannot be ignored, one that demands constant vigilance and awareness. Understanding the interplay between geopolitics and investing is crucial. Ignoring the political landscape is no longer an option for investors seeking to protect and grow their wealth. Ignoring the political landscape is no longer an option for investors seeking to protect and grow their wealth. It's a landscape that is constantly shifting, one that requires a keen eye and a steady hand. In the end, the interplay between politics and the stock market is a dance that requires both skill and intuition. It's a dance that can be mastered, but only by those who are willing to pay attention to the subtle cues and signals that guide it. By understanding this interplay, investors can navigate the turbulent waters of the financial world with greater confidence and foresight. It's a journey that demands both knowledge and resilience. The global financial markets are a testament to the interconnectedness of our world. Every decision, every event, has the potential to impact the markets in profound ways. As investors, it's our responsibility to stay informed, to understand the forces at play, and to make decisions that are both informed and strategic. Only then can we hope to thrive in this ever-changing landscape. So the next time you see a political event unfolding, remember that it's not just a headline. It's a signal, a cue, a piece of the puzzle that is the global financial market. And understanding it is key to navigating the complex dance of investing. Staying calm amidst the storm is crucial for prudent investors. In times of market volatility, it's easy to get swept up in the chaos and make hasty decisions. However, maintaining a level head can make all the difference in your investment outcomes. Market turmoil can be unsettling, even for the most seasoned investor. The constant fluctuations and negative news can create a sense of urgency and fear. But remember, every market has its ups and downs. The key is not to panic. Panicking can cloud your judgment and lead to decisions that you might regret later. Take a moment to breathe and gather your thoughts before making any moves. Knee-jerk reactions often lead to poor financial decisions. Selling off investments in a panic can result in significant losses, especially if the market rebounds shortly after. It's important to think long-term. Instead, take a deep breath and remember the fundamentals. Investing is a marathon, not a sprint. Focus on your long-term goals and the strategies you've put in place to achieve them. The first rule of investing is to stay calm. A calm mind can evaluate situations more clearly and make better decisions. It's about being rational and not letting emotions drive your actions. Emotional decisions rarely lead to financial success. When emotions take over, logic often takes a back seat. This can lead to impulsive actions that are not in your best interest. When markets are volatile, it's tempting to make rash decisions, but it's crucial to stick to your long-term investment strategy. Your strategy was designed with your goals and risk tolerance in mind, and it's important to trust the process. Review your portfolio, but resist the urge to make drastic changes. Regular reviews are important to ensure your investments are aligned with your goals, but drastic changes based on short-term market movements can be detrimental. Panic selling often results in locking in losses. When you sell in a panic, you might be selling at a low point, which means you're locking in your losses instead of giving your investments a chance to recover. Instead, Focus on the long-term outlook and remember that markets are cyclical. History has shown that markets tend to recover over time, and those who stay invested often come out ahead. This is also a good time to assess your risk tolerance. Market downturns can be a reality check, helping you understand how much risk you're truly comfortable with. If the recent market downturn has you losing sleep, it might be a sign that your portfolio is too aggressive for your comfort level. Consider rebalancing your portfolio to better match your risk tolerance and financial goals. Consulting with a financial advisor can provide valuable perspective and help you make informed decisions. They can offer guidance tailored to your specific situation and help you navigate through turbulent times. Staying informed and educated about market trends and investment principles can also empower you to make better decisions. Knowledge is a powerful tool in managing your investments wisely. Remember, investing is a journey. There will be ups and downs, but with a calm and informed approach, you can navigate through the storms and achieve your financial goals. Don't panic, prepare. Rather than fearing market volatility, savvy investors learn to navigate it. This involves understanding your risk tolerance, diversifying your portfolio, and staying informed about global events. Diversification is your best defense against market volatility. Don't put all your eggs in one basket. Instead, spread your investments across different asset classes, sectors, and geographies. Consider alternative investments like gold, real estate, or commodities. These assets can provide a hedge against inflation and market downturns. Remember, diversification is about spreading risk and reducing the impact of any single event on your portfolio. Finally, stay informed. The world is an increasingly complex place. Keep abreast of geopolitical developments and understand how they might impact your investments.